8 stocks Congress are buying right now by dividend talks. And we're going to do something a little bit different today. I'm going to go through all of these, and I'm also going to give you an options trade that I would make with these recommendations.
Of Congress outperformed the stock market in 2024, and if we take a look at the returns, quite a number of them actually had triple digits, whilst the vast majority, if not all of them, outperformed and by quite a significant distance. That isn't something that is new. If we were to look at 2023, again, many of them outperforming. In fact, we do have another number of them with triple digit returns. One of them, in fact, 239%, with the S&P at only 24.8 in comparison. But we can show you this, even if we go into 2022, we can see the S&P this year actually didn't perform that well. It had a return of negative 18%, if not all of them outperforming, and as we said, by quite a significant distance. And we just want to show you that the information is there to reinforce that for a very long time, members of Congress continue to perform very, very strongly. What's also interesting to note, it continues into 2025. Nancy Pelosi's husband.
We already know that members of Congress tend to outperform the market. Let's get to the stock picks.
First one, Amazon. As we already discussed, this is one that Nancy Pelosi has been adding, as well as many members of Congress. And yes, it has performed strongly over the last year, up nearly 50% over the last 10 years.
Amazon we know a lot about, but let's put on an options trade to capitalize upon this new information. If we look at the chart of Amazon, we can see that it's trading near its 52-week high, and it also has earnings coming up. Typically, I don't like making trades when stocks are trading near its 52-week high, but if I had to make a trade in this, then this is the trade that I would make. Its earnings are February 6th. I'm bullish on Amazon. I would purchase the 245. I would sell the 260. That would give me $1,500 of maximum profit for every contract that I put on. And this will cost me around $4.20 or $420 per contract. So then I would be looking to finance this. And I can do that by selling puts or calls at a strike price where I want to take ownership of the stock. In this case, because I'm bullish, I wouldn't mind owning it at 205. Then I would just set up the trade. And then you can see that I would get a small credit. With this trade, I'm agreeing to purchase Amazon at $205. This expires in March. And I'm also participating in the upside by purchasing a 245 by 260 call debit spread. Let's go back to the video and see what else he says.
Massive outperformance of the S&P, up 1,000. Their 5-year average for growth does look higher. We also want to point out the earnings, as we mentioned. First thing to note, we love to see green right across the board. We've gone 20% moving forwards. We have the discount.
Here for DCF analysis, I used to work as an investment banker for 5 years. You can look at my past videos where I recount my experiences and also where I share complicated financial models. We never rely upon discounted cash flow because it's so unreliable. I've probably put DCF analysis in a pitch book around 5 times in total. So this is nice to have, I guess, because it makes them look smart. But the reality is that Wall Street bankers rarely ever use it because there are so many variables that we know it's going to be wrong.
Rate, which ultimately gives us our $860 by the end of 23.5 for the buy.
The second one is Google, which is currently trading at about $200. Let's check out the preferred options trade. For Google, you can also see that it's trading near its 52-week high. Google has earnings in early February. If I was bullish on Google, then the trade I would make is I would buy the 210. I would sell the 225 and I would finance that by selling the 180. So here you can see 1, 1, 2. Now, when we make this trade, you have to be okay with actually owning Google at $180. Put yourself in the position where if the stock market were to fall 10% and there was a lot of fear, would you feel comfortable at that time owning Google at $180? And yes, you can manage the position and roll it downwards by a few dollars, but you're not going to be able to roll it down to 160. Maybe you'll be able to roll it down to 175 or an absolute minimum of $170. As you can see, when we set this up, we're going to receive a credit of $21. Let's check out what the next stock is.
By rating, and we can see that you do have the different and respective rates, giving you the values. based on the 12% upside of 8%. And if we do last year,
So Abbvie is the third stock. You could see that over the past 3 months, it's trading near its low. And over the past year, it's actually down. It has earnings on January 31st. In this situation, I'm not bullish or bearish on it. So what I might want to do is purchase a call debit spread and then also purchase a put debit spread. And then that will cost me around $538 for every tranche that I would put on. Then in a second trade, I can finance it by selling some puts and call options. Yeah, there's really not that much premium available in Abbvie, so I would actually skip this trade and not make it at all. Let's check out the fourth stock that he recommends.
over the last 10 years, not far off the will come shortly, and this also tells you the upside that Wall Street anticipate over the next year. Kansas City up only 2%.
The next one is CP. If we look at CP, over 1 year it's down, and over the past 3 months it's basically been treading water. For options, I would go out to March, and if I was bullish on this, I would buy the 85, sell the 90, and then I would finance that by selling 2 of the 72s. Let's look at the next recommendation.
Kansas City, attractive dividend at 3.
The next one is ExxonMobil, XOM. Let's check it out. Looking at the chart, we can see that over the past 3 months, XOM is down. And over the past year, it's up slightly. Regarding options, I can go out to March, and if I were bullish, then I can purchase the 115, and then I can sell the 125. By selling the 125, I'm not going to collect a lot of premium, so I'm not sure that this trade is going to be viable. And then as far as financing the call debit spread, I can sell the 95. I can switch this to a 112, and to put this trade on, I would pay $50 for every 112 that I would make. I would probably end up skipping this trade. Let's check out what the next recommendation is.
Over last year, over last trading right now, and it's 52-week high.
All right, so the next recommendation is Meta. Let's check it out. We can see that over the past year, Meta is up tremendously, almost 50%. Over the past 3 months, it's also up. As far as the options are concerned, we can go out to March, and then we can purchase the 670. We can sell the 700. That would then give us $3,000 in maximum profit for every call debit spread that we purchase. It would cost us about $1,000. Then to finance this trade, 2 of the 545s, 1, 1, 2, and that would give us a small credit of $27 for every tranche that we put on, and we would be agreeing to purchase Meta at $545. Let's check out what the next recommendation is.
And Wall Street, again, the buy rating.
Walmart is the next one. Over the past 3 months, Walmart's performed very well. Over the past year, it's also done exceptionally well. Let's check out the preferred trade. We can go out to March, and then if we're bullish on Walmart, we can purchase the 100 and then sell the 110. That would cost us about $130 for every call debit spread that we put on. We can then finance it by selling 2 of the 85s. With this structure, it'll cost us about $9 for every tranche that we put on. Let's check out the next recommendation.
Look at the growth rate, it gets a D minus, as we can see.
Home Depot is the last one. For Home Depot, over the past year, it's done pretty well, although I don't think it's kept up with the market. Over the past 3 months, it's also done pretty well. Let's check out the preferred option. We can go out to March, and if we were bullish, you can purchase the 420 and then sell the 445. This would give us a maximum profit of $2,000. It would cost us around $600 to purchase the call debit spread. And then to finance that, we would sell 2 of the 380s, and therefore we would be agreeing to purchase Home Depot at $380. Setting this up, 1, 2, and then for every call debit spread, we would receive $132. If you wanted to assume less risk, then you can reduce the 380 to 375 and still pick up around $25 a premium. Or if you wanted to reduce risk even more, you can reduce the strike down to 370 and then you would pay $124. This wraps up the top 8 stocks that Congress is buying right now with the suggested options trade. If you have any questions, leave a comment below. And if you like this video, then check out the video that's popping up on your screen right now because YouTube believes that you would enjoy it the most.